Hello friends, in this lecture we will continue with our discussion on retirement of partner. Right? In the last lecture we discussed about the amount that is payable to the retiring partner. Right? So in the last lecture we discussed how to calculate this amount payable to the retiring partner. That on the retirement we have to pay something to the retiring partner. What is that amount that is payable to him? We have to calculate that. Right? For that I told you various steps. I told you do all adjustments. Right? What do you mean by all adjustments? Calculate gaining ratio. Calculate new profit sharing ratio. Then do the adjustment for goodwill. Calculate the amount of goodwill that is payable to the retiring partner. Clear? Then do the adjustments for revaluation of assets and liabilities. How to do that? We'll prepare revaluation account. And we will calculate the profit or the loss on revaluation that is to be distributed among old partners in old ratio. Then check if there are any reserves and accumulated profits and losses appearing in the balance sheet. Right? Appearing in the old balance sheet, if there are any reserves and accumulated profits and losses appearing in the balance sheet, these have to be distributed among the old partners in old ratio. Clear? So first of all, do all the adjustments. You can see in the question, if you can see you have been given information about the goodwill, calculate the share of the retiring partner in goodwill. If you are given about the revaluation of assets and liabilities, prepare the revaluation account. If you have reserves and accumulated profits or losses in the balance sheet, then distribute those reserves and profits among old partners in old ratio. Clear, friends? After that, what you have to do is you have to prepare. After this, you have to prepare partners' capital accounts. For this, you have this information. Right? You have done this working, then you can easily prepare the partners' capital accounts. You will have the opening balances from the balance sheet given. You will have the share of goodwill. You will know the profit on revaluation of assets and liabilities. You will know the reserves, distribution of reserves and accumulated profits or losses. From this information, you can prepare the partners' capital accounts. Now, what you will get in the partners' capital accounts? For the continuing partners, you will say it is balance carried down. What about the retiring partner? We will get some balance in the partners' capital account. For the continuing partners, it will be the balance carried down. That this balance we will show in the new balance sheet of the continuing partners. What about the retiring partner? I told you in the last lecture that the retiring partners balance in the capital account, this will be transferred to loan account. This will be transferred to the retiring partner's loan account and unless otherwise agreed, it will carry an interest of 6%. Right? Unless otherwise agreed by the partners, it will carry the interest, this loan will carry the interest at the rate of 6%. Clear, friends? So, what are the steps? First of all, do all the adjustments regarding gaining ratio, new profit sharing ratio, goodwill, revaluation of assets and liabilities, reserves and accumulated profits and losses. Then after that, if you have all the information regarding this, if you have done the working on this, then you know how to prepare partners' capital accounts. After preparing the partners' capital accounts, what you will get is the balance carried down. Right? You will get the balance in all the partners' capital accounts. What that balance will reflect for the continuing partners, that will be the balance they will continue in the new balance sheet. For the retiring partner, that balance will be transferred to his loan account, and that loan will carry an interest of 6% unless otherwise agreed by the partners. Right? Unless otherwise agreed. Right? So what we have done here is, in the partners capital accounts, we have this balance reflects what this balance reflects. This reflects the amount that is payable to the retiring partner. Clear, friends? So this much we discussed in the last lecture. We did a practical problem also where we calculated the amount that is payable to the retiring partner. Now what we are going to do in the next topic is, we are going to see the methods of payment. Methods of payment to the retiring partner. Clear? First of all, we identified the amount that is payable to the retiring partner. Then we are saying that how we are going to pay that amount to the retiring partner. Ultimately, the continuing partners have to pay this amount to the retiring partner. How they are going to pay that? For that, the first is payment. Please keep writing, friends. Payment of full amount in lump sum. What they are doing is, first of all, they identified through the partners' capital accounts, they identified what is the amount that is payable to the retiring partner. Clear? Now, what they say is, they will pay the full amount in lump sum. They will pay the full amount. Whatever the amount you are getting, whatever the balance you are getting in the partners' capital accounts, they will pay the full amount to the retiring partner in one go. So can you tell me the journal entry for this? You have some amount in the partner's capital accounts, and instead of transferring that amount to the loan account, you are just clearing off the balance of the partner. You are paying him. So what will be the journal entry? Can you tell me? Think of it. You have an amount in the partner's capital account. You are paying that amount to the retiring partner. So which account will be debited and which account will be credited? I think identifying the credit account is very easy. If you are paying to someone, what will you credit? Obviously, you will credit either cash or bank. Right? So what will be the debit account? That is the question. The debit account will be the amount that is identified in the partner's capital account. So the account will be retiring partner's capital account debit to cash or bank account. Clear, friends? So we say whatever the amount that we have identified in the partner's capital accounts, we are paying that full amount to the retiring partner. So directly we will say retiring partner's capital account to cash or bank account. We are not transferring the amount to the loan account. We are capable of paying. The continuing partners decide that we will pay off whatever the amount that is due to the retiring partner, and they are paying it off. Clear? So directly the journal entry will be retiring partner's capital account debit to cash or bank account. Clear? Now the second scenario is payment in installments. Now, what the continuing partners say, they say that we do not have enough money right now to pay you. The continuing partners have to continue the business also. They say that, sir, we don't have the enough money because we have to run the business afresh now. So we don't have the money right now, full money to pay you. We will pay you in installments. Clear? So they say we will transfer your amount to your loan account. We will consider your payment as loan and we will repay that loan in installments. So what they are saying is whatever the balance you are getting in the partner's capital accounts, they will transfer to loan account. Whose loan account? Retiring partner's loan account. They will consider that amount as loan taken from the retiring partner, and on this loan they say we will pay interest. How much is the rate of interest? Unless otherwise agreed, it will be paid at 6% per annum. Clear? 6% per annum. So the second scenario is we are paying the amount of loan in installments and we are paying interest on that amount. Okay. Now, how to treat this? In this case, what we are doing is, see, first of all, we prepare partners' capital accounts. We calculate the balance and transfer to loan account. Right? Now to write off this loan in installments, we will prepare this loan account. This balance has been transferred to loan account. This loan account is now standing in the balance sheet of the new firm. Now when they will pay this loan account balance will decrease. Isn't it? Our liability of the new firm will decrease. Right? Now, let's take an example. Suppose that the amount payable to the retiring partner is rupees 30,000. And the continuing partners say that we will pay in 3 installments. Three yearly installments. Today they are sitting on 1/4/2016. They say we will pay you the first installment on 31st March 2017. Then we will pay you on 31st March 2018. Then on 19. We will pay this 30,000 in 3 installments. Okay, correct? So now we say what they do is they transfer this 30,000 to retiring partner's loan account. Very simple. And this loan will carry interest. At what rate? Unless otherwise agreed, this rate of interest will be 6% per annum. Now they ask you to prepare loan account. Very simple, friends. This preparing loan account is very simple. So you can prepare this with me, this loan account. If you know the concept, this will be very easy for you. Just focus on the concept, what the concept says. They say you have to pay some amount to the retiring partner. Identify how you will pay that. Right? Very simple. So here you will say date, particulars, amount, friends, do focus on the formats in exams, very important. Okay, so now you have a balance in the loan account. What is the balance in the loan account? On 1st of April, they transfer your balance in the loan account from the partner's capital accounts. They will say by partner's capital account 30,000. The balance in the capital account, they will transfer it to the retiring partner's loan account. What will be the journal entry? Retiring partner's capital account debit to retiring partner's loan account. So in the loan account, we will say by partner's capital accounts. Clear? Now you come at the year end 17. Now the continuing partners have decided to pay the interest at the rate of 6%. Now 1 year has elapsed. From 1/4/2016, the balance in the loan account was 30,000. Now you are standing at the year end, you have to pay interest also. What will be the interest? Interest will be 30,000 multiplied by 6% per annum. This comes to 1800. This is the yearly interest, first year interest. Now the continuing partners, they will have to pay what they decided. They decided to pay this 30,000 in 3 installments. This 30,000 in 3 installment means the installment of 10,000 each plus interest. Now what is the installment they will be paying? I'll say to bank. What will be the amount? What is the installment? 10,000. Why? Because this 30,000 is to be paid in 3 installments. Clear? Plus this yearly interest of 1800. So what is the total amount payable? 11,800. What is the balance amount in the loan account? Can you tell me? To balance, carry it down. This 30,000 was the opening balance. 1,800 was the interest liability. Out of this, 10,000 is paid. This 1,800 full is paid. What is left? 20,000 only. Clear? This is the balance that is carried forward to the next year. Clear? This is 31,800 and 31,800. Now when you come to the next year 1/4/17, you will say I have a balance. By balance brought down, you will say you have a balance of 20,000. Right? Now you have a balance in the loan account as 20,000. Now you come to the end of the year, that is 31st March 2018. 1 year has elapsed, 1/4/17 to 31/3 18. Now the date comes when your interest liability of the continuing partners arises. How much will be the interest? Just calculate the interest. How much will be the interest? What is the remaining amount? 20,000. This 20,000 is used by the continuing partners for this whole year. So we will calculate this interest on 20,000 only into 6%. This comes to 1200, right? And then on the same date, they will pay to bank. How much they will pay? 10,000 as the installment plus what is the yearly interest? 1,200. In all, they will be paying 11,200. On the same date, they will calculate their balance in the loan account. What will be the balance? Can you tell me? Out of this 20,000, 10,000 is paid as installment, right? On that, there was interest of 1,200, which is fully paid. So what is the balance left? 10,000. Right? So this comes to 21,200. Clear, friends? Now, how many installments now you have paid? You have paid 2 installments, right? 2 years have gone and you have paid 2 installments. Now, next year, 1,418, you have some balance. You will say, by balance brought down. What is the balance? 10,000. Now, come to the year end. 1 year has gone by. 31st of March 2019. Now what will happen? You have to pay some amount to the retiring partner. What is the amount? The first liability is, besides the basic amount, you have to pay the interest amount. What is your interest liability? Interest liability arises on the last date because you have used this money of the retiring partner for the full year. This comes to 600. Now, on the same date, you have to pay to the retiring partner his final balance. What will be the third installment of 10,000 plus whatever the interest for the year, that is 600. So you will pay him 10,600. Clear? So you are paying him 10,600. Clear, friends? So this is how you have to pay the loan of the retiring partner. There are 2 methods. The first is pay at the time of retirement. Make the full and final settlement in lump sum. The journal entry will be retiring partner's capital account debit to cash or bank. Clear? The second alternative is the continuing partners decide that they will make the payment to the retiring partner in installments. For that, on the date of retirement, they will transfer the balance in partner's capital account to the loan account of the retiring partner. They will consider that amount as loan to the firm, and they decide that they will pay this loan in installments and they will pay interest on that. Right? So that's the example. 30,000 is the amount payable. They transfer it to the retiring partner's loan account. Unless otherwise agreed, this loan account will carry an interest of 6% per annum. Remember this, very, very important. Right? Okay. So this is how we are going to prepare the loan account. First of all, we'll say what is the total amount payable to the retiring partner. For the first year, what will be the interest? 30,000 into 6%. Right? Then on the last date, we are paying the installment plus interest. And we will find out the balance that will be carried to the next year. Clear? Then next year, the balance amount we are using for the whole year. So at the end, we have some interest liability. We will calculate the interest on the balance amount. Be careful with this balance amount, okay? We have to calculate interest on this balance amount. Then on the last date, we will pay the installment plus the interest for the year. Again, we will calculate the balance amount. Again, for the next year, we have the interest liability at the end of the year because we are using that money for the whole year, right? And finally, we will pay off the amount, the total amount that is payable to the retiring partner. Right, friends? So we have discussed two things. The first is the amount that is payable to the retiring partner. First of all, we calculated that. Then we discussed how to distribute, how to make the payment of that amount to the retiring partner. For that, there are two methods, either in lump sum or either in installments. If you are doing in installments, you have to prepare the loan account for all the years. Clear? But to know the amount of loan, you will have to do all the calculations. You must be clear with all the basic concepts like calculation of new profit sharing ratio, gaining ratio, goodwill, revaluation, reserves. Everything should be on your tips. You should be clear that if the question asks about the goodwill, if the information is given about the goodwill, how to treat the goodwill, you should be knowing that. If you have information about revaluation of assets and liabilities, you should be clear about how to prepare the revaluation account and how to distribute the profit of revaluation. That profit will be distributed among all partners in old ratio. Then you should be clear about the treatment of various reserves and accumulated profits that will be appearing in the balance sheet on the date of retirement. Clear? You can be asked a full-fledged question. So be careful. Do all the adjustment first. Prepare partners' capital accounts. Identify the loan, amount of loan. Then pay off the loan. You will be given all the information in the question. Don't worry about that. Okay. Clear, friends? So you can write this down, this loan account. A very simple topic, but a very important one, because we have to make some payments to the retiring partner. We have to identify what is payable and how we are going to pay. That also we have to decide on that date only. Clear? I hope this is clear. If you still have any doubts, you can always write to me at ksjteaching@gmail.com, right? If you have any queries, any questions, you can anytime email me at this address. Okay. So what we are going to do in the next lecture? In the next lecture, we are going to do a new topic, that is adjustment of capitals. Adjustment of capitals in case of retirement. Right? We have done adjustment of capitals in case of admission also. So here also we are going to do this topic, that is adjustment of capitals in case of retirement. For reference, you can go through those topics of admission. These are somewhere in the last lectures, okay? Last lectures of admission. So you can go through those lectures, but I will go in detail in retirement also. Okay? So don't worry about that. I hope you all have noted down this loan account. This is very, very important. Be careful in treating this. Okay? So that's all for this lecture, friends. Thank you so much.